This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Marshall Auerback joining us this morning from New York. Marshall is Director of Institutional Partnerships at the George Soros-founded Institute for New Economic Thinking, or what is referred to as INET. Marshall, maybe we can begin with you describing how you came about joining INET.
So in 2008, I decided that what we were seeing was unprecedented, historic, and I still wanted to observe it, but I didn't feel like being an active practitioner. I had done some work beforehand for another think tank called the Roosevelt Institute. The director there, one of the directors there, Rob Johnson, who used to work with George Soros, was a fund manager, called me up and asked me if I'd be interested in joining the Institute for New Economic Thinking. The idea behind the Institute is that it's really to answer the question posed by the Queen. You know, why did so many people miss this? And I think we felt that part of the real problem is that the mainstream economics profession is in love with these neoclassical models that have no bearing on actual reality. They treat finance as a footnote. We thought it was important to establish a new institute which could revive the teaching of economics and hopefully have a more sensible policy discourse which reflected in economics as it is seen and in the real world, as opposed to one which is a stylized version that you see in the economics textbook. So that's how it all started, and we've been going now for about 5 years.
Well, I encourage our listeners to go to your site or to the site. You're doing great work, and to support INET. You've done some great interviews too, by the way, so I compliment you on them. We're here to talk about financial repression. I wonder if we could begin with you defining what you see it to be in your words.
Yeah, I'm happy to do so. I mean, I think financial repression can be a fairly loaded word. I mean, I think you could say that anytime you have a central bank which is a monopoly issuer of anything, whether it be a currency or interest rates, there's a degree of financial repression in the sense that any monopolist can establish a price. So I'm less concerned with the labels and more concerned with the fact that we have been, in response to this unprecedented crisis, we've been undertaking increasingly exotic experiments on the part of the central banks, notably quantitative easing, which have had the effect of repressing interest rates or keeping them low, which of course is great for borrowers, but does have the unintended byproduct of hurting savers, depriving people of income. And I think it's also an experiment which is flawed in terms of the economics behind it. I don't think it does much to elevate aggregate demand, a fancy word that we economists use for spending power. And I think it turns out to be a large implicit subsidy for the financial sector. And as far as I'm concerned, we're already overly financialized as an economy. We do too much for the banks anyway. And it's really a fundamentally mistaken policy approach.
What trends are you seeing in that regard on a global basis?
Well, I mean, the obvious ones, we had, 3 rounds of QE, quantitative easing by the Fed. We have the Bank of Japan undertaking a similar venture in Tokyo. And more recently, now the European Central Bank has announced that it will start to undertake quantitative easing in their part of the world. And if you actually look at the impact, it's been fairly minimal so far. I mean, the Japanese economy is still pretty stagnant. In the last quarter, it grew at 1.5%, but it contracted substantially before that. The U.S. is growing, but I would say that has less to do with quantitative easing and more to do with the fact that we had a fairly robust fiscal policy response after the crisis in 2009. Likewise in Europe, it's been admired in depression-like numbers, which are worse than anything we had in the 1930s. So It hasn't really worked, and yet we keep trying it. The economics behind it are flawed. It's based on this notion that if a bank buys a bond and puts reserves in the banking system, that somehow it can encourage the banker to lend. That's wrong on two parts. One is we don't actually lend out reserves. Reserves are only used for interbank lending amongst banks. But the second and equally important construct is that lending is a two-way process between you have to have a creditworthy borrower on the other side, and you have to have a creditworthy lender. And if you have individuals or businesses that are piled down with debt, they may not be very creditworthy, or they may be less inclined to take on more debt to support sustain their businesses. So the idea is you want to be able to engender rising employment, rising incomes, so that people aren't as reliant on credit. And I think that's a big problem that our system has had over the last 30 years. It's become increasingly credit-centric rather than income-centric.
Yeah, I would argue, Marshall, quite strongly that actually capitalism is more or less dying on the vine, and I say that when you contrast it to credit. That is, capitalism is about savings and applying that savings into productive assets that will produce real income. What we're doing now is we're actually trying to drive consumption through credit. And the growth is coming out of consumption. The problem with that, it sometimes can be a short-term solution, is consumption doesn't create net cash flow which pays the debt. So at some point that equilibrium is out of balance. Is that too simplistic?
No, I think that's fundamentally right. I mean, look, we spent trillions of dollars bailing out the banks in 2008. We didn't do this in the 1930s, by the way. We effectively nationalized a certain number of banks, shut them down, recapitalized them with government funding. But we replaced management, and at the meantime, we had a significant form of debt restructuring. Here, we're not actually fundamentally changing the system in the form that got us into this mess in the first place. We're just handing out money to the banks willy-nilly. I'd rather see those trillions of dollars go into the hands of individual consumers who at least could spend the money and drive economic activity. But more importantly, I just think that we've been conducting this pulmonary resuscitation of what's fundamentally a dead financial system, rather than using the money to try to revive the economy and transition it into more productive economic activities, as you suggest.
I noticed last quarter, 90% of all profits of the S&P 500 were returned to shareholders as either buybacks or dividends, which would leave a maximum of 10% for investment. And you can see top-line growth continuing to fall, irrelevant of earnings per share, as there are less shares outstanding. By definition, you can't have economic growth in that kind of sustained environment.
Yeah, I agree. I mean, this is something I commented on about 2 years ago. We had record profits as a percentage of GDP, but you were having no top-line growth. And you can only do so much financial engineering and cost restructuring in order to flatter your bottom line. But at a certain point, you've got to get people to buy your products. The problem is when you have an economy which is overly financialized, in which banks account for a disproportionate amount of activity, and you have an incentive structure in place, a compensation incentive structure in place, which is highly dependent on share price appreciation, then you provide a very perverse incentive for businesses not to invest in productive parts of their businesses, but to use excess cash to buy back shares, because of course they get paid on how their stock performs. They get a nice generous amount of options. This is the CEOs I'm talking about here, and senior employees. So they can cash out in a few years' time. Then if the business by that point is loaded up with a lot more debt, who cares? They've taken their $10 or $15 million payday and move to the beach somewhere. So it's a real problem. And worse than that is that you have an incentive to begin to use all sorts of accounting tricks to misstate earnings. This is what Professor Bill Black of the University of Missouri in Kansas City calls control fraud. And it's become a major feature of our system over the last few years. So you get a form of casino capitalism. In fact, I think that's a very unfair term, because I think the casinos in Las Vegas are actually regulated more favorably than the banks are.
Precisely.
And actually, once in a while, they have to pay the house. So, it doesn't work so my apologies to the Las Vegas casino owners for making that comparison.
I think Black's work is right on, and it really gets to the core of the problem of the 2008, 2007, 2008 crisis of what had led up to it through the whole mortgage debacle. of what the large institutions were really doing.
They were engaged.
How they should have been
Yeah,
prosecuted.
no, absolutely. They should have been prosecuted. They were engaged in fraudulent activity. There's ample documentation. The Department of Justice says they weren't able to find evidence, but if you don't look, you don't find. All you have to do is check the loan tapes. We prosecuted far more executives from the savings and loan debacle in the 1990s, and that's when we had a Republican president. We have been operating under this strange assumption that somehow if you prosecute banks, even for criminal activity, and the HSBC was involved in documented cases of drug laundering, money laundering for terrorists, sort of the so-called bad guys that we throw in jail. There's been documented cases of that, and all they received were fines. They were significant fines in real terms, 1.9 billion, but in fact, nothing compared to the magnitude of the crimes that were committed. And the thinking is, well, if we start prosecuting these guys, if we start imposing the rule of law, that somehow we're going to create another financial crisis. My own feeling is that if you don't prosecute, if you subvert the rule of law, then you don't have a proper functioning capitalist system. And more to the point, is you have a situation where it's what's called Gresham's law, where bad money drives out good, and so your system becomes fundamentally more corrupt. It becomes a kind of crony capitalism of the sort that we, for example, like to criticize the Russians for having.
Well, that's exactly it. The good money's forced out the bad.
Yes.
The bad money's forced out the good money.
Yeah.
You do have this level of crony capitalism, and what happens is, in my opinion, is you get almost a tribute system going on, sort of like the mafia, that movie, The Goodfellas, when he said, nobody understands that really the Don was there to protect them because there was no police department for them to go to, and they paid the tribute. And what's happening now is, you look at it as a business proposition. You say, what's the fine? What's the cost? And the payouts are typically, 10% of what your total profits are when nobody goes to jail. It's only when somebody goes to jail the behavior changes.
Yeah, that's right.
So the S&B, the debacle with the savings and loans in the early 90s, people went to jail.
Yeah.
We went through bankruptcies and restructuring. We did, as you pointed out, in the 30s, the same thing. This last time around, we did none of that. We just subsidized the losses. So anyway, a long story there, but we won't revisit that. But Marshall, is the core problem we just have too much debt in the world, both public and private?
That is a big problem. I would say private debt is more of a problem than public debt. If you actually look at the great economic crises that we've had over the last 100 years or even longer, they've usually been preceded by large buildups of private debt. You saw that in the 1920s, leading to the Great Depression. You saw that in the more recent crisis. I mean, we've had this massive expansion of private debt. This, of course, goes back to the problem that over the last 30 or 40 years, you've had growing inequalities. You've had the middle class under a lot of pressure. They have undertaken increasing forms of debt to try to sustain their lifestyles. And that, of course, has led to an underlying financial fragility. And, of course, it's fine to take on the debt as long as the economy continues to grow. You can continue to service it. But when you have a demand shock of the kind that we had in 2008, all of a sudden people can't service their debts. And their mortgages go bad, and the financing structures that were used were fundamentally fragile. So we had this big expansion of public debt in response to that, in the sense that the so-called shadow banking system was effectively taken out of the shadows and put on the balance sheet of the Federal Reserve. And likewise, a lot of these other debts were taken on board by the federal government. We got no corresponding benefit for that because, as you pointed out, there was no sanction attached to that. And now these same people that were the biggest beneficiaries of these bailouts are now saying, we've got way too much public debt. We've got to cut that back. We've got to cut back Social Security, Medicare, even though these were not the proximate causes of the crisis in 2008. So it's, again, a pretty perverse example of the political capture we have of the wrong kind of people running our system.
Yeah, they may not have been the cause then, but they could be the cause of the next crisis. The degree of underfunded pensions that we have right now, the size of entitlement programs that are also completely unfunded, no matter what kind of accounting.
Well, they're always funded in the sense, to the extent that you can always create the dollars to fund them. But I mean, it's
exactly. But what can they buy?
Well, that's the question, and so I guess I focus, it's a question of numerator and denominator. You want to grow GDP so that these things, because at least if you grow GDP, you get more taxpayers into the system. They pay into these programs and they can grow again. I mean, we had a similar talk about the solvency problem of Social Security in 1983. Alan Greenspan came along, set up a commission. We increased the payroll tax, and that was supposed to solve the problem once and for all. Well, here we are a bit later, and we've got the problem all over again. But again, this problem tends to become more evident when you have high rates of unemployment and when you have the automatic stabilizers kicking into effect, which pay out more in the way of non-discretionary welfare programs. So the idea, as far as I'm concerned, is that you want to create an environment where you can increase employment, jobs, and so that and that's also fundamentally the best form of financial stability as well, because obviously when someone's got a job and he's paying down his debt and his incomes are increasing, the bank gets their money back, the credit card companies get paid, and you get a lot less of this kind of debt build up. So it's cause and effect. I think you can't just simply cut entitlements at a time of a recession without having some corresponding growth initiative. And I think that's the problem we've had in Europe, for example. They continue to preach the politics of austerity, and it's actually made things worse in countries like Italy, Greece, Spain, etc.
Well, I think they've thrown in the towel on any austerity talk. Anybody who has been removed from power. So.
Well, they have in Greece, but whether they're able to escape the austerity yoke. I mean, when you're in a form of debtor's jail, until your jailer, in this case it's the Germans, unlock the key and let you out, you still have a bit of a problem. So we'll see what happens there. But that could be the source of the next big financial hiccup if we don't resolve Greece in a proper way. I mean, I know a lot of people say that, well, Greece is that tiny little bit of GDP, we can ring fence the problem, but of course that's what we said about Lehman Brothers in 2008. So who knows?
In terms of new economic thinking and ideas that would better address debts and the degree of debt around the world, what is INET seeing? What's coming to surface?
Well, one thing I will say is that I think the term, the title "New Economic Thinking," in one sense is a bit misleading, because I think we're really more an institute for sound economic thinking, and a lot of that entails bringing back some of the wisdom of some of the economists of the past before we became overly mathematized, before we fell in love with mathematical models that had no relationship to reality. So there's a lot of things we look at. My particular focus is employment. I've said before, I think you solve a lot of problems by getting a much fuller employment, and one of the things that the ideas that I've looked at over the last few years is a job guarantee program. It's not unlike the sorts of programs that were introduced during the New Deal, but I would make this a permanent feature of government. And when people say, well, you're just going to be creating another level of government bureaucracy, I say, no, I'm trying to in effect replace much of the bureaucracy that's there for the unemployment insurance, the welfare, the food stamp, and replace that with programs which are designed to put people to work. And at least then we could find out how much unemployment is involuntary, how much is voluntary. So the government, in effect, acts like a buffer stock. It expands when the levels of private sector unemployment are high to absorb workers, get them placed in jobs. It may not be the same jobs they were in before, but it gets them working again. And this creates, if you like, a shovel-ready buffer stock of employers that can transition back into the private sector as and when the private sector wants to hire again. That's, I think, a fairly good idea. Well, I'm concerned that we have not fundamentally downsized the financialization of our economy. In 2006, the so-called FIRE sector, that's finance, insurance, and real estate, accounted for over 40% of all profits in GDP, which is a sign really of the tail wagging the dog. Wall Street has to be at the service of Main Street, and if anything, the concentration of power at Wall Street, the 4 or 5 big Wall Street banks, the amount of deposits that they hold on behalf of most Americans, which is now in excess of 50%, that's too high. Their political power is too high. And as a result, you get the same kind of perverse economic and financial experiments being undertaken that got us into trouble in the first place. We haven't fundamentally changed that. Well, maybe we need another financial crisis to do it, which is not a pleasant thought. Rahm Emanuel in 2008 says you don't want to let a good crisis go to waste. Well, unfortunately, I think we did let a good crisis go to waste. I mean, look, I'm not in a position where I'm saying you need 25% unemployment to break the power of the banks. But, as I like to say, 25% unemployment at least got us Glass-Steagall. 10% unemployment got us Dodd-Frank, which clearly is not enough. Yeah. That's right. And no, I agree. And in fairness to the central bankers whom I was criticizing earlier, I think part of the problem why they've undertaken these increasingly exotic experiments is it's in part a reflection of the political dysfunction that we're facing right now. The political class is not stepping up and doing what needs to be done. So the central bankers feel they've got to do something. What they're doing is actually, I think, making the problem worse. So it's certainly not improving it by any stretch. And I think really we've got a fundamentally corrupt system of government here, which I think is the real problem. It's in many respects it's a political economy problem rather than an economics problem we have right now.
Leadership.
Yeah.
Free by a reliance.
Yeah. Yeah, absolutely. That's right.
Only to do that.
Yeah. No, that's true. Although I think in many cases the pills we were prevented from taking those ugly pills because the cronies who run the things at the top are still happily feeding themselves at the trough and see no reason to change the system. So you need some sort of crisis which fundamentally discredits them and galvanizes people. I mean, in the last elections, we had over $4 billion of money being spent in the midterm elections. That's historically unprecedented. But we had, about a 40% turnout, and you really need something about double that. You need people to be politically engaged, but if they see no hope, they don't get politically engaged. So it's a real problem.
Until they really feel it at the grocery store, at the gas pump, with pitchforks, and it can switch.
Yes.
Out of time. Any key messages you'd like to leave with our listeners?
I guess the key message is get involved, and there is a way of changing the system, but it takes a lot of work at the grassroots, and I think if you don't start it, then these guys are going to slip in a whole bunch of new types of laws, which is going to screw you in the end again. So I think it's important for people to stay engaged and involved and be vigilant, as Thomas Jefferson once said.
Marshall, how can our listeners more about your work, your writing, and the things you're involved with, and INET overall?
Well, they can, thanks for the plug. They can check our website, which is www.ineteconomics.org. That's one word, ineteconomics.org. They'll not only see my work, they'll see some of the interviews I've done with various economic thinkers, and there's a lot of good scholarship that's presented there. And I would urge your listeners to take a look.
Marshall, thank you for sharing your time with us today. I appreciate it. I know our listeners will, and we'll have to have you back later in the year.
Gordon, it's been a great pleasure. Always nice to talk to a fellow Canadian.
Talk to you. Bye.
Okay. Thanks a lot. Bye-bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed iTunes, and other social networking venues at GordonTLong.com.